For investors, the beginning of 2022 has been a roller coaster ride. The stock market plunged in January as investors fretted about inflation and rising interest rates, and Russia's invasion of Ukraine in February sparked yet another wave of financial turmoil. Since the outbreak of the coronavirus began in 2020, there has been discussion about the prospect of another stock market crash as a result of the fear and uncertainty around what would happen next. So, would the stock market have a correction in the second half of the year 2022? And how bad will the correction be? Hello and welcome back to Crypto Cash Channel. What do you know about the foretold market crash? In today's video, we look at why the market might crash. But, first, before we go on, a sub to the channel would be very appreciated. Comment, share the video and don't forget to leave a thumbs up for the video. So, let's get into it. February and January had been particularly difficult months for stock market investors in the United States, but March provided some much-needed relief. The S&P 500 increased by 3.6% in the month, suggesting some recovery from the harsh correction that occurred over the previous 2 months, which saw equities plummet by as much as 13% from all-time highs. In the first quarter of 2022, all major market indexes suffered their worst quarterly losses in more than 2 years, with the S&P 500 falling by 4.6% and the Nasdaq Composite falling by as much as 9%. But in March, the Federal Reserve raised interest rates for the first time in more than 4 years, after having lowered them to near zero levels during the onset of the COVID-19 epidemic in late 2020. With Fed Chair Jerome Powell hinted at a rate hike in March since the winter, the move was expected, and the markets were unfazed by the news. However, in order to battle sky-high inflation, the Federal Reserve aims to boost interest rates throughout 2022 while simultaneously shrinking its record $9 trillion balance sheet. And one of the concerns is that the Federal Reserve may go too far and trigger a recession. The Russian invasion of Ukraine continues, despite intermittent peace efforts, posing a threat to the European economy, as well as to American corporate investment and consumer spending, according to the World Economic Forum. Combined, these factors have resulted in a volatile investing environment that may persist. Well, uncertainty is the root source of volatility, and it's pretty clear that the bond and stock markets will continue volatile until we get some degree of assurance. Because of the high values of the S&P 500, the market is currently anticipating just a 1.25% dividend return from the index. To put it another way, everyone is delighted to receive $59 every year in return for every $4,700 they have put in. That is an all-time low for the stock market in the United States, and it is practically the lowest level ever. The index's historical average is close to 4.25%, which is more than 3 times higher than the index's current value. So, what happens if the Federal Reserve decides to raise interest rates in the coming months? Consequently, people would partially disinvest as a result of the rising attractiveness of such alternatives, and the market would begin to demand larger dividend returns from stocks once more, due to both the higher cost of capital and the opportunity cost. And that is the point at which the S&P 500 would almost certainly collapse, since no one would be ready to acquire the index for the 1.25% dividend that it presently pays out. But what would be the magnitude of the drop? Well, it all relies on how much interest rates rise, and determining how much interest rates rise is basic mathematics. Because the reasoning is straightforward, if the Federal Reserve raises interest rates by 2%, the market should expect a correspondingly high increase in dividend yield, bringing it closer to 3.2%. Consider how the dividend yield is calculated, the amount of money paid out divided by the price of the stock. This will help you determine how much it would decline. However, even if the interest rate were to rise, the dividend in dollars paid by the S&P 500 would remain the same at $59 per share as it is currently. In other words, if the Federal Reserve raises interest rates by more than 2.0% and the market believes the increase is permanent, the S&P 500 may fall by as much as 50% in value. And although it's not a perfect connection, it might be more or less accurate, but it's still a reasonable substitute. If price pressure persists for a longer period of time than expected, the Federal Reserve would be obliged to raise interest rates even more, which would be devastating. I'm not even talking about a 20% hyperinflation scenario. Rather, I'm thinking about what was considered normal in the past century, a stable inflation rate of 3 to 5% each year on average. With interest rates at such high levels, it's no surprise that the mean and median dividend yields on the S&P 500 are likewise between 4.0 and 4.5%. Thus, if interest rates were raised to 2.5 or 3%, and the market anticipated a 3 to 4% dividend yield instead of the present 1%, the S&P 500 would have to sell for almost $1,500 per share. And in order for it to revert to its late 2013 price levels, it would have to plunge by 50 to 60% and remain there. Another thing to keep in mind while planning your hike is the time frame. As previously said, in order for the rate to decline, the market must feel that the rate is set in stone. If the market feels that the Federal Reserve will be forced to lower rates soon, the impact will almost surely be mitigated, which is exactly what the market is doing right now, since it does not believe that the Federal Reserve will be able to raise rates. So, who will emerge victorious at the end of the day? Well, the stock market panicked in 2018 because of this, so the chances of this happening are currently low, which is a relief, but they will continue to climb as long as inflation continues to rise, so keep that in mind. The most likely scenario at this time is for interest rates to climb to 0.75% in 2022, according to analysts' predictions. And according to such a scenario, the market decline would be worth only around 20 to 30%. If it's only 20%, it's not even a crash, it's just a correction in the market. Also, that's approximately the amount of money Goldman Sachs and other financial institutions predict the market will lose in 2022, which is equivalent to what we saw in the fourth quarter of 2018 when the Federal Reserve began hiking interest rates. Treasury rates on 2-year and 10-year notes have reversed for the first time since 2019, indicating the probability of a recession in the near future. Short-term bond rates are higher than long-term bond rates when the yield curve is inverted. This is a sign of an oncoming crisis, but analysts caution that it is only one of the numerous recession signs. Economic improvement has been overshadowed in recent months by a variety of other concerns, including geopolitical issues, particularly Russia's invasion of Ukraine, and a decline in the number of COVID-19 infections. It is these dynamics that are presently driving the stock market, and corporate America's halting desires to bring employees back into the office indicates that the pandemic is not yet in the rearview mirror. Experts, on the other hand, anticipate that market participants will be very laser-focused on any data that provides better clarity about the economy for the first time in a long time. Because, even before the major yield curve inverted, some investors were speculating about the possibility of a future recession, mostly due to the possibility that continuous increasing prices would dampen consumer spending. During the month of April, the first of 3 estimates for GDP growth for the first quarter was expected to be announced, with the final report scheduled for publication on April 28. So, in the next weeks, many investors will be thinking about the start of the earnings season, which begins in the following weeks. A major subject of conversation for corporate executives, particularly about the impact of inflation on profit margins and demand, is likely to be inflation. In the first quarter, according to FactSet figures, analysts estimate earnings growth of 4.8% for S&P 500 companies, which would be the lowest rate of growth since late 2020. In the long run, experts believe the economy and stock market have a reason to be optimistic. Nevertheless, the guessing game about how fast they will develop is likely to result in extended market volatility. The absence of a Federal Reserve meeting in April might worsen the situation. But one thing is for sure, except that the lapse in time will serve as another source of increased volatility and uncertainty over the Fed. And that's it for today's video. Thanks for your time and attention. How soon do you think the recession will hit? And how hard will it hit us? Comment below. Let's engage. Also, if you are interested in more videos like this, make sure you like this video and subscribe to our channel. Don't forget to turn on the notification bell for more amazing videos. See you in the next video.